morning and welcome back. This is hour number 2 of Tampa Home Talk. We had a great time with you guys talking about updates and improvements. I love throwing myself under the bus because I think it helps relate to what to do and what not to do.
That fourth segment was just depressing on the amount of money spent on a house.
Well, a little, but it's, again, do it for enjoyment. It's one of the things, the pool, right, goes right there in line with that. You do it for enjoyment, not for resale.
My neighborhood has a beautiful pool, Cascaden Park. I'm sure you're familiar with it, Adam.
Oh, yeah.
It's a beautiful pool. It's got tennis ball and the little mini tennis ball, like the wiffle ball type courts. It's got basketball court, football field.
The wiffle ball type courts. Are you talking about racquetball?
No, that's in a box. You play that in a box.
Okay.
But I can enjoy all of this for like a $10 a month membership, which would be like 70 or 80 years.
Your neighbor has this privately?
Neighborhood has a public pool with membership.
Yeah, but is it clothing optional like at mine?
Only Pat.
You mean your sinkhole in the backyard, Pat?
He's not going to talk to us for the rest of the hour. He's mad.
You guys got to get new material.
Hey, that's Leo, not me.
I can recommend ground injection as new material for your sinkhole.
Shush. Shush it.
Let's introduce our guest.
All right, so let's welcome Sarah Cricky, official show partner for Tampa Home Talk. Welcome.
Good morning.
It's been a couple minutes since we had you.
It has, yeah.
So this girl, I'm just going to put her right out there because she knows her stuff. She's been doing it for a long time. If there's anything mortgage related that can be done, this girl can do it. What she doesn't like is when I throw her on the air. She kind of does it, I think, just to pacify me. So, are you nervous or no?
I'm okay.
Yeah, she's gotten better than she was the first time she was on the air with us.
I've never known her to be nervous on the air.
No, she doesn't seem like it, but usually I know she's like, oh, I got to be on the air again. I'll just do the loan. But anyway, so our topic we have today, some really cool stuff. I prepared some stuff as well, Sarah. I know we were originally planning to talk about down payment assistance, which ties in so nicely with a call we got Wednesday on Trenner Show about the Sadowski Fund, right? The doc stamps on the deed funding that for affordable housing. And we were going to cover this because there's been plenty of money. And then ironically enough, city's not taking apps, right? Which means they're running out of money, we think?
The city of Tampa is not currently taking applications. They are changing their down payment assistance programs, though. So as soon as funds are available, we'll have a lot of good stuff to talk about.
I know Pasco ran out of money really quick. It seems like Pinellas never has any money.
They did. They ran out pretty fast. And
fast.
I checked with Pasco, and their allocated funds for next year are small as well.
It doesn't make any sense, but we're going to dive into that a little bit in the coming weeks ahead. One of the things we did when we changed gears a little bit, and you're going to talk about, is the FHA spot approval, which this is really important. We probably should back up and just kind of roll through pre-market crash, post-market crash, how that affected condos and FHA buyers and where we are now. Can we back up and kind of explain the whole thing to paint a picture for the person listening?
So when our market had the collapse that it had back in 2008, condos took a big hit in Florida.
Yes.
So
yeah, they were taboo. I was one of the last loans that I write. I'll share a story real quick, and I've shared this with you, Sarah. But my mother-in-law literally had 3 credit scores, all in the 800s. Almost doesn't. You never see that hardly ever, right? She was buying a condo, was an auction property, which is like not for every buyer. Been in the job for 30 years. Really perfect, all around. Banks typically would be saying, "How fast can you sign Miss Madewell?" Well, that's not what happened. This is right at the time when the market was still crashing and burning. Banks were imploding on a daily basis. She was putting 20% down on a condo. It was classified as a condo. You would look at it, you would call it a townhome, right? It's got a residential elevator and stuff, but it's classified condo, so it's a condo. And basically, they became taboo in Florida, and the banks and investors decided they don't want to do condos anymore, so they changed. I'm talking overnight, no grandfather period. We were submitted for a clear to close, and the underwriter literally called me back and said, "Yeah, I know you were looking at 80% LTV, which is 20% down. The investor changed your guidelines to 70%, so now your mother-in-law has to put 30% down." And they have all your bank statements and everything, so they knew she really didn't have it. So we got them to make an exception for 25% down, but that was like pulling teeth, and it was awful. And that was like one of the last mortgage deals that I wrote personally before I connected with Sarah, and really she's been around for a decade and a half at this point.
Well, historically, you got to talk about why they pulled out of condos. So you had investors who owned a bunch of condos, basically on margin. They couldn't afford it. Their arm hit, which is that adjustable rate mortgage. They couldn't afford these things, so they walked away from them. So they were high-risk properties for lenders because people own multiple of them. It's easier to walk away from what you don't live in. Coupled that with, once you have so many people that walked away from their condos, the condos aren't collecting the dues. So now your dues, so the people who aren't being foreclosed on have their condo dues double and triple, so now they can't afford to live there.
Or
It became-
special assessments.
Yeah. Now they can't sell it because
They can't
nobody
sell
can
it.
qualify.
So it just snowballed to the point where, as at the time I was on a condominium board, our condo had foreclosed on 30 units.
Yeah.
So we foreclosed on the units to turn them into rentals to make the money back that we were losing.
To keep your balance
To
budget.
because we
So-
couldn't raise dues, because then we would just be making more people be foreclosed on.
One more thing we should chat about is probably relevant for you to chime in on, Leo. Couple everything you just said with the fact that apartments were being converted to condos.
Well, that was right before the collapse. Like, once you start getting apartments converting to condos, you know the market's about to tank.
But here's the thing,
That-
too.
you know,
are
a lot of people said that's the warning sign when you get all these apartment buildings converting to condos, because that's when all the people with money are cashing out, basically.
are they built the same, though? I don't think they are.
No, I mean, I've been in several lawsuits about condo conversions and how they were advertised and falsely advertised, because they were advertising apartment buildings as condos, and there's apartment quality and condo quality. And when they were converting, they were saying, well, compare us to Sky Point, compare us to Bainbridge, compare us to places that were built as condos when they were really apartments.
I'm going to say some of the huge differences might be firewalls in between the units. Is there
No,
anything else?
You get the firewalls.
They all have it?
Just think of it like this, like apartment construction is mostly going to be wood frame, 3 stories, 4 stories.
Mm-hmm.
Condominium is going to be block. It's a quality difference
Yeah.
at that point.
Now I have a question. Since we're talking about condos, have they
His ears all perked up.
have they changed any of the guidelines for that? Because there's so many condos going up in Tampa.
Yeah.
Is it just for the super wealthy, and that's how it is?
No, that's what Sarah's going to get into as well. And
Okay.
she's got a lot of meat and the potatoes
Oops,
on that.
sorry.
But we wanted to just kind of back up and kind of get to where what we're alluding to, ultimately where this conversation is going. Because after the housing crash, banks didn't want to write condos anymore, right, Sarah? So if you had a condo, you were SOL unless you had cash.
Yeah, and it took several years for it to start evolving back to the way it was. So in today's market, you can actually get a conventional condo loan with as little as 5% down.
One of the things too, like FHA had so many condo communities approved, and I remember we were helping buyers looking, even though when the market had kind of restabilized, the condo market took a lot longer to come back.
Correct.
And FHA, like when you look at the list, there's not many that are approved, right? Still.
6% in the entire country
Yeah.
are FHA approved. In our area, it's a very short list.
I think I remember looking in Pasco, and there was 1 or 2 communities that were condos that were approved.
Right.
So that's where you get what you call the spot approval, which is kind of where we're going today, right?
Yeah, so in a conventional program, and I'm going to compare that to FHA. In a conventional program in today's market, you can go as little as 5% down.
And this is owner-occupant.
Owner-occupied. However, you're going to have to document the entire community, bylaws, declaration, budget, get a full condo questionnaire, and it has to meet all of the criteria for Fannie and Freddie to be warrantable.
Now explain what that means. What does that mean when it's warrantable? And basically, what are lenders looking for in those questionnaires and that sort of stuff?
Fannie and Freddie have lists, just like FHA, of pre-approved condominium associations. There are some things that will make a community not warrantable. For example, they don't have enough reserves in their budget.
What are they looking for?
10%.
Okay.
Yeah.
Well, let's explain why reserves are important, right?
Sure. You don't want the community to be underfunded, because then you get into a situation where you can be facing special assessments and additional fees.
Yep. Those reserves are huge, and lenders know that.
And that's just one component. I mean, the questionnaire is a pretty long, lengthy questionnaire. They want to understand if one entity owns more than a certain percentage.
Why would that matter?
They want to understand if the developers release control to the unit owners. I mean, there's a list of questions there.
If I was buying a condo, that's where I would start.
The percentage of owner occupancy has to do with more than one entity owning
ton.
15 units
Yeah.
in the same complex.
All right, you're listening to Tampa Home Talk. I can promise you an exciting, fun-filled, action-packed, knowledgeable hour. If you have questions or you want to know something about what we're chatting about, 813-377-2775. We will answer them during the hour. Call or text 813-377-2775.
Oh, good morning. Welcome back. This is Leo Kane here with Barrel Engineering and Inspection. We were talking off air about one of our 4-point inspections and wind mitigation inspections, in case you heard a little snippet of that. But I'm here with Katrina Madewell.
And we're talking condos, which is really exciting. I love it.
And with Adam lives in a condo, don't you?
It's an apartment, but it's close. It's condo. It is quando. It is quando. It is condo quality, though. Like you were asking.
I love it.
Yeah.
He's been
Make it worse
brainwashed by the marketing people. I live in a condo quality apartment.
Quando.
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 That's
Love
a
it.
misnomer. When you get in a condominium and every unit's slightly different, and a lot of unit owners will rent them out, you're really at the mercy for how much care they put into it. Where if you live into an apartment, you might have sub-quality everything compared to condo, but at least you have maintenance staff.
At least it's the same too, right?
Yeah.
Same throughout. All right. So fast forward in the market we're at now, we still don't have hardly any condos FHA approved, right?
So back to, again, the comparison to conventional. If the condo meets all of the required criteria with regards to the questionnaire for Fannie and Freddie, the borrower, owner-occupied, can go as low as 5% down. If there's some concerns about the community, the borrower has the ability to go 25% down and do what's called a limited review. And then you don't have to supply that questionnaire. You don't have to supply all the bylaws, the budget. You simply have to evidence that the community has adequate insurance and that they're not currently dealing with any legal litigation. And by legal litigation, I mean the community itself, not a unit owner who's personally in foreclosure.
Yeah, they want to make sure your HOA is not being sued.
Right. And so,
Can we spend a minute on that? Because honestly, if I was going to buy a condo, that's where I would start, would be the budget and the condo questionnaire. Even though it's an upfront expense to pay for that, I think, even before my inspection,
I would
look
just
at
start
that.
by requesting, and I'd say this to everyone that asks me about condos, you always start by requesting a copy of the budget and a copy of the reserve study. Legally, they are supposed to have a reserve study on file. A lot of times they don't. They don't know what they're putting into reserves and why they're doing it. So you have a company come in and do a reserve study, and dues go way up.
There's a lot of laws, very tricky.
Florida Statute 718.
Yes, with regards to condo, that requires a lot of disclosure. That's a lot of outs for a buyer. I'll put it that way.
Yeah.
Like you can get out of a contract pretty easily as a buyer in a condo, just because chances are they probably didn't follow the rules with regards to disclosure and that sort of stuff. But let's talk about real quick, like what are they looking for in terms of like what percentage of owner occupant, what percentage of reserves, like what are we looking for exactly? Like what should be a red flag where someone's like, oh, I'm going to walk away.
so talking about FHA, they're looking for a 10% in reserves, and they were looking for 51% owner occupancy, but they're actually relaxing that to 50%.
Say 10% of their total budget?
Correct.
Okay. And then owner occupancy, 50%. So 50% of the people live there and occupy it primarily.
Correct.
And what else?
They want to understand if the control's been turned over to the unit owners. They want to understand the amount of commercial space, if any, a community has. Again, if there's any legal litigation, if they have adequate insurance, fidelity bonds, things like that matter. If any of the unit owners are delinquent, that can be a problem.
Really? So if just one person in the entire condo complex is delinquent,
No, actually,
or it's like a percentage?
It's called
then?
bad debt, and it's usually a percentage.
well, it's a percentage, and it has to do largely with the size of the community. I mean, you can have a 10-unit condo community and have 3 people delinquent, and that's a problem versus a 200-unit
Right.
complex.
That makes sense.
So
You've got a bigger percentage of your unit owners in default at that
Right.
point.
So in terms of FHA, again, it's a very short list of approved communities. Back in the day, we would be able to do what's called a spot approval, which is where you can take one unit, get it approved with FHA, even though the community as a whole does not have FHA or HUD approval. That became extinct, and effective October 15th, it's back. So we have the ability to do spot approvals for FHA.
That's awesome.
And that's not with a higher down payment. That's still the FHA required 3.5% down.
It's a good sign that it's finally normalized with regards to condos.
To quote one of our commercials, that's you.
So what happens, and we don't even need financials to get an FHA spot approval, which is fabulous. What happens is HUD has a form, and it's called a 9991, that is a 5-page questionnaire. The community fills that out, provided they answer all of the financial questions correctly and adequately for HUD. They rely solely on this form and can approve a unit within a complex. They are looking for some key components. Definitely with regards to the community's financial stability, there are 3 major points. They want, again, to make sure that 10% of the budget is in reserves. They want to make sure that the reserve account is separate from the operating account. They don't want anything commingled. You'd be surprised.
Well, you think about it. You talked about relinquishing developer control, and now you have people that might not be a CAM manager, but could be people that live in there that are managing and running the HOA.
Right.
If they haven't had any training, I mean, I can see where that would happen.
But I like this because when I know a condo's on an FHA list, they are following Florida Statute 718, and they're doing what they're supposed to be doing. A lot of these rules that these lenders are asking for are nothing more than what's already being required of them.
Now, I'm curious because we talked about how the association needs to be properly insured, that kind of stuff, and we're talking about budgets. Do they look at what, say, for instance, like the hurricane deductible on that condo policy?
They do. They look at co-insurance clauses. That's a big deal. Okay, if there's a co-insurance clause, but yeah, they do. They pay attention not just to the limit or the amount of coverage, but
how much comes out of pocket when something happens. Yeah,
correct.
Some larger associations actually have a reserve line item for deductible.
Yeah, well, that's good. Well, you don't want a special assessment to meet a hurricane claim. That's rough.
That's right. So the third point on what the FHA spot approval is looking for in terms of the community being financially stable is that not more than, and it's not a percentage in this spot approval, it's not more than 15 units delinquent, more than 2 months on their HOA dues. So
15 units total, regardless of how big the community is?
Correct.
That's
so it
tough
doesn't
for
matter
the
if there's
larger
20
ones.
units or there's 2,000.
And on that point, I'm glad you brought that up because, again, this is a spot approval in a community that is not FHA approved.
Which most of them are not.
So because the community itself is not approved, FHA says, well, we'll lend in there, but we don't want a lot of concentration in there if it's an unapproved community as a whole. So if it's a community that's larger than 10 units, the current FHA concentration in terms of people financing in that community with FHA mortgages cannot be more than 10%.
Oh, wow.
If the community is 10 units or less, no more than 2 people can have an FHA loan already existing in that community. So spot approvals are available now on communities that are not approved, communities where the approval has expired or was withdrawn, and even communities that were rejected. And so,
how often are they supposed to update their approval?
So they actually just extended that. So your approval would now be good as a community from where it was 2 years, now 3, and then they have to reapply. But on the note of rejected communities, if a community was rejected 4 years ago because maybe the FHA or the delinquencies on HOA dues or the concentration FHA had in the community.
Yeah, that's crazy. They can be rejected just because a certain number of owners have an FHA loan.
But that's why they're actually still doing spot approvals in rejected communities because things have changed. I mean, things may have changed. A unit owner that had an FHA loan may have sold. Other properties sold. HOA dues are caught up now. Things can change over time that would actually make a spot approval able to happen in what was a previously rejected community.
And the rules are totally different for conventional.
Correct.
Right?
Yeah.
Now, question for you. When we're talking about these HOA dues, is that something that can be escrowed into the mortgage?
So mortgage lenders never escrow HOA dues.
That's a shame.
They definitely do, obviously, insurance because that's their collateral, and they definitely do real estate tax because...
And their PMI.
Right.
And their mortgage insurance. But all communities govern themselves differently with regards to HOA dues.
Okay.
Some are due monthly, quarterly, semi-annually, and they don't monitor that. So it's always going to be a separate bill.
It'd be nice if it
Yeah.
did, right? Because I'm sure you're calculating that when you're doing your numbers as far as their ratios and everything,
sure.
right?
We have to compute that into the ratio. We certainly disclose to the client what their mortgage payment is and their HOA dues, so they know their total out of pocket, but it's never going to be a part of the loan.
If it's an expense, they want to know about it. They're calculating,
some
and
of
that's
the,
the
you know,
income ratio.
if you look on Zillow, some of the HOA dues out there, like for these condos, are ridiculous.
Well, here's the thing. I'm going to give you an example of a property I've listed right now.
Mm-hmm.
This one's technically a condo. Oh, I don't have it here.
Oh no!
I'm gonna have to get
we're gonna
it.
come back.
I think the dues are around $600 or so in that community. It's a $400,000 unit,
A month?
but yes, the community actually has a private beach.
Oof.
And there's flood insurance required in there. All of that's included in the master policy for the HOA, and the limits are pretty high.
And we'll talk about the insurance for the flood insurance for condos. There's a little caveat with that too. So
That can be your tip. for
Yeah,
this
when we come
hour.
back. Yeah.
I will print that information, that listing, and tell you about it. It's actually a really good deal. A lot of the stuff in there is in the mid fours or five, so it's a really good deal. This one being at 400. Perfect for snowbird season. Like I
Yes.
can see somebody moving from New York, New Jersey, and this place would be awesome. All right, you're listening to Tampa Home Talk. Our off-air number is 813-377-2775. You can call or text us 813-377-2775.
And welcome back to Tampa Home Talk. This is Adam Talley with Talley Insurance.
I thought you were Leo.
I'm not Leo. I'm not award-winning like Leo is.
kidding.
And while we dive back in, I want to talk about the flood insurance on condos. So, with the National Flood Insurance Program, you can only insure a property up to $250,000. So, if the condo association is already insuring your property for that much, you can't get flood insurance through the NFIP. You can get some excess coverage for your unit, but you can't get the standard NFIP coverage.
Would those additional endorsements we were talking about in hour one apply?
Yeah, because that's not regulated. That's not regulated by the NFIP, but you don't want to be overinsured either, right?
Yeah.
So if you're, we discovered this. There's like those townhome type condos.
Yep.
Where there's $600,000. Obviously, you can go above the 250 and still have a need there.
This is a townhome type condo, right? It's classified as a condo per the bylaws and the legal description. But if you were to look at it, you'd call it a townhome. It's got a residential elevator, 3 stories, literally 4-car tandem garage. So it's a pretty nice property. There's a lot of stuff that's included in the $780 fee per month. So you got my sheet there, Adam. Look at some of the stuff that's included for the community as well as the things that it pays for. So you have to keep in mind, sometimes people look at the dues and they go, oh, that's high. But then when you look at everything that actually covers, not so much.
Yeah, it's a lot.
So basically the 780, not only is it going to cover all of your exterior of the property, including the roof and everything, but it's going to include all your ground maintenance, your pest control, your water, your sewer, your trash, community pool. It includes cable. There's a boat ramp there. Again, I mentioned it has its own private beach, fitness center, sidewalks, tennis courts, water access, obviously. So there's a lot of stuff this includes. So for $400,000 to live in a community with its own private beach, literally walking distance, not a bad deal.
That's pretty good. But what does $600 a month, or you said that was $780?
$780.
What does $780 a month equate to as far as like an increase in purchase price that you could have on a mortgage?
If you were buying single family?
Yeah.
Well, that's probably a Sarah question, but
Well, we have the experts here today. That's why I asked.
$780, if we multiply that out times 12, that's $9,300 a year.
Times 30. Right.
Not really, but that's $280 over 30 years. It's not really how they calculate it.
Right.
So I don't know. We can run some numbers. Let's see here. I got my little mortgage calculator on here. Let's throw this in here. We'll calculate a $400,000 house.
Right.
What rate should we plug in, Sarah? I'll do 20% conventional.
3875.
No, the rates are all different, but let's do 3.875. That's a weird number. So you're financing $320,000 on a 30-year note. That makes the payment, let's call it an even $1,505. It's a little less than that. And so your question was $9,300 a year,
right? What would you get for? Because if it's $1,505, then you'd be somewhere around 23, right? Close to it.
If it's what now?
Because I'm talking about how much more could you spend on a house if you were putting that $780 into your mortgage, not into an association fee.
So this is what
you
I'm...
have to think about the association fee is also going for reserves, so it's like, are you, even though you're only spending $1,505 a month, are you taking an additional $300 a month and putting it into a separate account? So if you need a roof or an AC system,
Right. I know it's not apples to apples. I'm just thinking like overall,
Generically speaking, about another $120,000.
Thank you. We don't need to get too technical. Sorry, it was
Maybe a
more
little
technical
more,
question
but
than Okay,
That's how
cool.
much more house. Yeah.
Awesome.
Well, I'm
you
gonna-
still have to save for capital
you
improvements.
do.
Yes, I understand. I'm
And then-
just.
So now you have to factor in if you have if you do your own landscaping or you sub that out, you do your own lawn maintenance, your AC maintenance. There's all these maintenance things that just go into that $300 or $400 a month for HOA dues.
Right.
I mean, just subtracting the straight $9,300 right off the top, right? If you're financing $320 versus like $312 or whatever it is. I mean, the mortgage payment alone, $1,505 minus $1,458, $47
Right.
a month for all the amenities, plus, like you said, all the capital improvements, the maintenance, your reserve.
The pool
That's a pretty
maintenance.
big amount. Yeah, and you have a pool. I
And a
mean, you can't
beach.
even maintain your own pool at your house yourself for $40 a month.
Right.
Yeah. So I mean, there's that to factor into.
Definitely some value there.
For sure. It's all on how you look at it, right? It's all about perspective.
Absolutely.
All right, where do we leave off, Sarah?
So let's talk about the FHA spot approval. Just to back up, this is a 5-page questionnaire, and if the community meets the requirements on this questionnaire, then HUD will approve a spot approval for 1 unit to be financed in a community that's not currently FHA approved. Cool little fact, once you're able to accomplish that, we're able to accomplish that as the lender, the documentation is good for 90 days. So you as a realtor, provided they're not exceeding the FHA concentration in that community, can go sell another unit in that community and secure a spot approval.
Well, if it's good for 90 days, run with it.
Correct. Yeah. So, so you're not in a community. That's how HUD looks at paperwork expiring. It's good for 90 days, and once it's approved on 1 unit, provided, like I said, the concentration's not too high, you can go sell another, and they can get an FHA spot
I
approval.
mean,
as
that's
well.
pretty accurate. 90 days, I would say it's a really accurate picture
Yeah,
before things
yeah.
could change.
There are some things right out the gate that are going to make a community completely ineligible, regardless. Brand new construction condos are not going to be eligible for a spot approval.
How long do they have to be around before they're...
A year.
Okay.
Yeah, a year.
Why is that?
That's not too bad.
They want to see some type of there's not enough time to build that history to even answer the questionnaire,
Right.
if that makes sense. Okay. They don't want it to be a condotel or a
Condotel.
they call
Condotel.
condo
hotel.
So that's going to be your short-term rentals, your concierge service, your
Airbibs.
correct.
Well, your condo hotels literally have maximum amounts of time that you can occupy them personally.
Well,
So
and
don't
how does
forget
that
about
factor
that.
in? I mean, I wouldn't necessarily consider this a condotel, but the addition that's coming to downtown Tampa is going to be like half hotel, but like nice hotel.
But they're not zoned condotel, right? There's a separate hotel and then separate condo
Same building.
units.
Or we refer to those as
It's mixed
resorts.
units.
Resorts.
Condotels are called resorts.
But it's a mixed
gotcha.
unit community. It's no different with it being commercial, right? Downstairs and then residential condos upstairs.
Yeah.
Right? Is that fair to say? You think? I think it's fair.
No, mixed use.
It's a fair comparison.
I like the mixed use properties where you have commercial and retail and restaurant on the first floor. And
That's
then
what
you
I'm
have,
saying.
yeah.
I don't think, in my opinion, it's a whole lot different if you're putting a hotel, right? That's probably going to have a coffee shop in it. Condos are smaller spaces, so if you have guests, they have a place to stay without it being your home.
Yeah. Interesting.
Yeah.
So they don't like timeshares.
Okay.
Who does?
They don't want to make they don't want to make spot approvals in houseboat communities.
Yeah, I don't even think, can you even get a mortgage loan for that? I don't think so.
Is that
Maybe-
considered a condo?
I feel like they might. it's funny. There are some manufactured home parks, and you run into this a lot in the Keys, that are actually classified as condominium complexes.
Really?
And they're
Wow.
manufactured. So again, on this list, no manufactured, no houseboats, no continuing care facilities. It cannot be a.
ALF.
Yep.
No
cannot-
ALFs, no sniffs.
Correct. They're
Skilled
not
nursing
making.
facility.
They're not making spot approvals in communities with less than 5 units. They're not making spot approvals
Ooh, less than 5 units. Yeah, that would be.
That's a tiny one.
yeah, that's a
I
big
ca-
deal.
I can only think of one complex that I know of that's 5 units, so it's less than 5, so that one would qualify because it's 5.
It would have a shot unless three unit owners currently had FHA financing.
I guess less than 5, you're just called a quadplex.
Yeah. At
No.
that point, yeah.
No, the difference is you have 4 deeds versus 1.
No.
Big difference.
Yeah. So
Quadruplex has 1 deed, 4 units.
correct.
A 4-unit condo could all be attached, but they have 4 deeds.
Correct.
Okay.
If the
Looks the same from the outside, very different.
Is everybody on the board for the HOA at that point with 4?
Well, you just need a president and then
treasurer, secretary,
and a vice president. But I mean, I think the vice president can be the treasurer, so 3 of the 4 would have to be on there.
That's funny.
so
Wait, 2 of the 4. 3 of the 4 or 2 of the 4?
3 of the 4 would have to be on because you need to have a president, a VP/treasurer, and then a secretary.
Okay.
so
It could be an outside person, too. It could be a CAM manager or somebody else. You pay for it, but it could be.
Anyways, back to her. Sorry for
okay,
the
so
sideshow.
they want the community to be at least a year old. Again, no new construction. They want it to have been occupied, not just sitting there vacant. Okay. They're not making spot approvals in areas that are defined as being in the coastal barrier resource system.
All right. What does that mean?
So what happens is we have, and we can actually look, just like you would look up a property in USDA in terms of eligibility. There's actually a website where we look the property up, and you're going to find that it's only going to impact the coastline, the immediate coastline, okay? But these are areas where overdevelopment has created a problem and depleted natural resources, habitats, things like that. So they're really discouraging further development of those areas. And so for that reason, FHA won't make a loan or a spot approval if the property falls within that map. And we obviously have, a way to check and look it up.
So flood was a surprisingly good topic today because we call this a COBRA zone, and you can't get flood insurance.
There you go.
We had a house insured in Port St. Joe, and you're talking only about $350,000 for like the actual dwelling coverage. The flood insurance premium was like $8,000 a year.
So more than the mortgage almost, right? Not quite, but
He
close.
bought it cash, so it didn't matter.
Yeah.
But yeah,
So it would have to be to
Yeah.
make sense. Did he self-insure flood?
no, he bought it.
But I mean, did he get the flood insurance?
Yeah.
Okay.
Yeah, and they have, there are a couple other nuances. I mean, FHA spot approval requirement with regards to the type of insurance the community has is going to be different from conventional. They have real specific rules, for example, regarding fidelity bonds and the amount that they need to be for an FHA spot approval. The coverage needs to be at least 3 months of the HOA dues per unit plus the amount in the reserve account, and that has to be what the fidelity coverage is for. So little nuances there. Again, all on this questionnaire. If this questionnaire is complete and meets the requirements, then no further documentation is needed.
Well, I mean, there's, again, when it comes to condos, it's a whole different animal. Not only is someone else regulating how money is spent, where money is spent, reserve requirements, voting on things. If you live in a condo community, you should absolutely be involved. It's not like a single family HOA community. Totally different, in my opinion, especially if their master policy is covering a lot of stuff.
So the
community.
FHA spot approval is really going to help with the 3.5% down payment, first-time home buyer, people that don't have the resources to maintain a single-family residence or a property. It's just going to make it a lot easier.
All right, stick around.
Yeah.
We're going to continue talking about this right after the break.
Well, good morning. This is Leo Kane with Barrel Engineering and Inspection, joined with Adam Talley from Talley Insurance.
Feels like afternoon. We've been here so long.
I know it does. Katrina Madewell with Tampa Home Talk, and Keller Williams, and Sarah Cricky with Summit Mortgage.
Yeah, and so what we've been talking about for the last 45 minutes might be Greek to most people listening. The good news is you have us on your side to help you through this stuff. If you have any questions, our author number is 813-377-2775. Maybe you're thinking about selling your condo and you want to know how all of this stuff might affect you. Good time to reach out. 813-377-2775. You can call or text condo. We'll know roughly what you're looking for. 813-377-2775. While we have a few minutes, Sarah, let's chat about avoiding PMI, shall we? Like if you don't have 20% to put down, we were talking about FHA and, it's a little bit of the extreme, right? The condo and conventional FHA spot approvals and that sort of stuff, which is typically your 3.5% down, which is not much, right? For a condo. But what about if someone has a little bit more they're putting down, like 5 or 10%, and they don't want to pay PMI, which, by the way, FHA is now for the life of the loan. I'm waiting for them to modify that again.
So in an FHA loan, it's called MIP, Mortgage Insurance Protection, and it is a factor that is set and applies to the whole country. It's not credit score driven. It is a 1.75% upfront mortgage insurance requirement that's financed into the loan, and it is a factor of 0.85 with 3.5% down, and if you're putting more than 3.5%, the factor becomes 0.80. And it doesn't change, like from a 580 credit score to an 800 credit score. It is what it is.
Well, it's meant for a lot of first-time home buyers.
Right.
Might have some credit challenges.
That mortgage insurance will remain on the loan for the life of the loan. FHA used to remove or reduce it when you hit a 78% loan to value, and
that's how it was everywhere. When the market crashed, they just made it permanent, which is ridiculous.
Right.
But
So in a conventional loan,
they also increased their rates, by the way. They quadrupled really from that time.
the factors used to be a lot lower, correct?
They were like 0.25, right? And now they're how much?
0.85.
Yeah, so they tripled.
But they actually were higher than that a few years ago. They were actually over 1% in the monthly factor, and they've come down a little
So
bit.
they did quadruple.
Yeah.
They should have come down a lot more, though.
Yeah. So in a conventional loan, in order to avoid what they refer to as PMI, private mortgage insurance, you have to come in with a down payment of at least 20%. The private mortgage insurance is not a set factor. It is privately underwritten. So the mortgage insurance companies that issue those certificates are looking at credit score, loan to value, debt ratio, same things that the mortgage underwriter is looking at in terms of securing a rate. And so someone with a higher credit score is going to have less expensive mortgage insurance, the same price point, than someone with a lower score. And so it can really vary drastically. Some folks interested in a conventional loan end up going FHA because the cost of that mortgage insurance is less than half of what it would be in conventional.
There's a couple ways to actually avoid it entirely, right? So you can do what they call lender-paid PMI, which I don't know that I'm in love with, but that's an option.
So lender-paid mortgage insurance is still mortgage insurance.
Right.
And so typically when the lender pays the mortgage insurance, you don't see it broken down as a part of your monthly payment, but it has to be paid for, and that typically is going to impact the pricing and your interest rate.
Now, are they paying for it or self-insuring it? I think it depends on the bank, right? Are some of them self-insuring it at a higher rate?
They can in some portfolio products, but typically it's lender paid directly to the mortgage insurance carrier.
One of the ones we do a lot actually is we partner up with a local bank, and so many times people will put just 10% down,
right? And
we'll do what they call the 80-10-10. Those were popular back in the day. They still exist. We saw more 80-15-5, so they could do 5% down versus 10. But if you have like around 10% or you can get there, it's a really great option. I love it.
Yeah. So and there are some banks out there doing that. You're going to find a lot of the banks are still capping the combined loan to value at 80 or 85. There are a handful out there that'll go to 89.9, which is effectively 10%. You bring 10, they lend 10, and you get a first mortgage for 80. And because your first mortgage is 80, you avoid that mortgage insurance.
Average price house, average credit score, conventional loan, 10% down. Let's say it's a $300,000 house. Someone's got 10% to put down. Roughly, what's the mortgage insurance on that? I know it depends on credit and a whole bunch of stuff. But what do you think that would be roughly on a $300,000 house?
With a high credit score,
Let's say an average credit score of everything you see.
in excess of $300 a month with regards to the mortgage insurance.
Wow.
So when you look at, and the bank that we use has a crazy, like under 2% intro rate for a year. So you're talking about $300 of PMI. And if it's a $300,000 home, let's calculate 10% of that. They're doing an equity line of around 30,000. I want to make sure I'm calculating this right, Sarah.
So you're going to multiply by 1.99.
Is that right? Their payment's about $50 a month on that
Correct.
line. That
That's
sounds
correct.
about right.
Yep.
So $300 a month mortgage insurance compared to now it's going to be interest only at $50. But let's just say, hypothetically speaking, you pay that $300 payment towards that second loan,
Right.
not the $50 minimum interest payment. You're not paying the lender to insure default.
Correct.
Assure against default. That's all it is.
And even though the equity lines those rates are typically teaser rates that expire in a year, it then moves to prime plus a margin. You're still coming out ahead. You can control that line, pay it off, have a really pretty fixed first mortgage with no mortgage insurance, without the need to refinance the loan or to ask the servicer to remove it and justify that with an appraisal. And then that line's paid off. When you're able to pay it off, it remains open for you to reuse if you have an emergency or anything like that.
Doing some real
What's the
quick
length?
math.
What's the length on that, or is it just open forever?
So they vary from bank to bank, but suffice to say the more aggressive ones will go to 89.9%. They amortize out for 30. They're probably going to close the line at 20 and make you start paying that principal back.
Okay.
So they're reusable for, depending on the program, 10 to 20 years.
Oh wow.
But here's the thing, just looking at I'm calculating just a simple $250. It's not this simple, the number's a little more complex. But let's say it's $30,000 in this example. The extra $250, which would be the principal, right? The difference between the $300 PMI and the $50 for interest, which is actually going to go down. But simple math, that's paid off in 10 years.
Yeah.
You know what I'm saying? Versus your MIP.
Forever.
Yeah, I mean, for one, now your debt service or your balance on your mortgage is going to be less than it would just taking a straight 30-year or 15-year fix.
If you've got mortgage insurance in your conventional loan right now and you feel like your value's gone up, your equity position is stronger, you don't have to refinance your loan in order to remove that mortgage insurance. There are rules you have to follow, but you can request it with your servicer. They're probably going to want an appraisal to understand the current market of your property.
We're here to help. If you've got questions, again, we want you to love where you live, even if that's your existing home. You can call or text us at 377-2775. We'll help you anytime. You can call or text us 813-377-2775. Again, call or text 813-377-2775. Thanks for joining us, Sarah. It's been a great hour.
Thank you for having me.
All right, love where you live. We're going to fix it. Welcome home. We'll be back next week for another 2 hours.